Hello, I'm Edouard Demeire, professor at various business schools and faculty member at Agile Pharma. This short video intends to review how to improve the productivity of pharma portfolio management at the affiliate level. Pharma portfolio management has been made very challenging in this VUCA environment we currently live. For example, the market has become quite volatile. Infliximab biosimilars have taken nearly 100% of the originator's market share in some of the Eastern European countries, whereas, for example, in Canada, infliximab, promoted by a local company, has hardly taken a percentage patient share. Uncertainty dominates also in areas such as access. Complexity of the portfolio has become much greater, as a lot of big pharma companies used to have big blockbuster brands, which were clearly the priority, move into a scenario now where different companies have a whole series of much smaller brands, where portfolio prioritization becomes much more complex. And finally, there is ambiguity. How can one correlate the level of investment to the returns, for example, when medical investments become very important? How do affiliate processes then handle this challenging external environment in terms of their portfolio resource prioritization? Most pharma companies will have some global long-term strategic plans, which then influence local strategic prioritization and the longer term. In Q2 of a year, brand plans then get written, where brand teams face this trade-off between writing simple plans, which are based on one particular set of external assumptions and one strategic option, versus writing longer plans with contingency planning, etc., which then lay out different options. In Q3, typically, affiliates then get into financial planning processes where bottom-up numbers are sent to first regional and then afterwards global planning functions. Those then get reworked at the global level, come back down in Q4 to the affiliate level, where there will be all sorts of haggling and massaging of a brand plan to fit into those financial targets. Very often teams get told, listen, we would like you to spend 20% less, and we assume that you can get 10% more budget, which is coming from a purely financial perspective. We propose to go through a process which will more systematically trade off long-term strategic investments at the affiliate level with short-term financial optimization objectives. Strategic long-term planning processes typically include any of these three types of tools. Some pharma companies make extensive net present value analysis. The key challenge in a VUCA environment is, of course, to forecast longer-term sales situations, given the uncertainty in access, in loss of exclusivity, in competitive situations, etc., etc. Less financially driven but simple approaches then include, for example, the old Boston Consulting Group portfolio matrix, which included cash cows, stars, question marks, etc., which is these days a bit old school, as the criteria used in this portfolio matrix tend to be probably a bit overly simple, just looking at market share and market growth perspectives. More often used are the directional policy matrices. Directional policy matrices look at disease market attractiveness by analyzing multiple criteria such as level of patient unmet need, ability to get access, competition, size of the market, growth of the market at the affiliate level, etc., etc., as one dimension, the vertical dimension. The horizontal dimension typically looks at competitive strengths such as a product differentiation, the ability to serve the marketplace because of the knowledge an organization has built up of a particular therapeutic area over time. Clearly, the yellow bubble is the ideal situation where you should invest as much as possible, as the brand is in a highly attractive disease market and your competitive advantage is very strong. The blue bubble here is typically a more cash cow situation where you have strong competitive advantage, but there's no more growth, there's increasing competition, there could be price pressures, etc., where the strategy is going to be to maintain. The green bubble is going to typically be in challenging situations where disease market attractiveness is very high, but the competitive strength has not been built up yet. This particular type of brand will require a lot of resource to overcome the competitive weakness it has at this particular point in time, which might include all sorts of medical investment, it might include all sorts of commercial or access efforts that a company might make. As a company then gets involved in the more short-term and more tactical brand plans, it looks at patient flows to help identify key leverage points. For example, key leverage point 1 would be about developing diagnostic of a particular disease to increase the patient pool. Key leverage point 2 would, for example, increase drug treatment of this particular diagnosed patient population. Key leverage point 3 would induce trying to move patients from an old injectable drug formulation to a newer oral drug, which probably gets both patient preference and also reduces payer costs. And key leverage point 4 then is about developing greater compliance of this particular oral drug therapy. Clearly, at the short term, key leverage point 4 is probably going to be a low cost, high sales impact if you can really increase the 50% non-compliance. Key leverage point 3 will already be a little bit more challenging. Key leverage point 2, which is to change medical practice by increasing drug treatment, will probably be again a bit more expensive and a bit harder to achieve. And finally, increasing diagnosis, if that requires, for example, patient-based disease awareness campaign, changes of diagnostic habits of primary care physicians, that would be extremely expensive and it may not lead to that much additional sales. In a more efficient portfolio planning perspective, we would then not assume that a brand team has the individual ability to make the choice which of these different key leverage points should be pursued. Here what we do is we then look at different options. Option 0 could be just simply to cut, the expense would then be 0, and the brand would just have a bit of carryover sales from last year. Option 1 would then include pursuing the base case, which is to focus on compliance adherence as a key leverage point. And that would cost a little bit because you would need to induce things like patient education kits and also train nurses to achieve compliance if that's required. And so the additional sales would be the carryover plus the effect of the increased compliance. If a team would have increased spend, then they would be able to get greater resources in order to not only pursue the compliance key leverage point, but also fight for patient share. That would then yield carryover sales, plus the increases in sales resulting from the patient share increase, plus the switches, plus the compliance. Finally, if the team had maximum spend, they could do all of the above, plus increasing diagnostic rate and treatment rate, which would increase the sales as above, plus result in an increased patient population. It is our assumption that an individual team cannot select the best strategic option here, because that would not only depend on that brand team's results, it would depend on the whole portfolio result. So a brand planning process that looks at each of these options could give senior management more of an opportunity to trade off different options for the different brands. In order to facilitate this process, we can actually graphically represent what are the various scenarios of investment for option 0, option 1, option 2, and option 3, how much sales this is anticipated to yield in a 1-year horizon, which teams should be able to estimate even in VUCA environments where long-term forecasts are really extremely prone to error. and then look at the cost implication of pursuing option 0, which was cut everything so that 0. Option 1 would cost a little bit more, option 2 would cost a little bit more, etc. If you then want to understand the profit impact of these various options, which mean increasing the number of key leverage points that you want to activate, then you can simply deduct the sales from the cost line, which is shown on the graph here below. Now, we are not suggesting just to optimize the short-term perspectives. What we are suggesting is to actually have different short-term objectives for the different brands based on the strategic priorities that came, for example, from a directional policy matrix longer-term perspective. If you are launching a strategic brand, your objective will clearly be to maximize first-year sales, which in this particular condition would yield you to maximize the investment, even if the 1-year profit is going to be a bit lower than if you spent a bit less. If you have a strategic brand, but that is maturing, that has, let's say, 2 years of patent life yet left and not a lot of upside, you would probably be focusing the investment on the place where the short-term profits are actually seen to be optimal. If you have a mature brand which is really being deprioritized, the challenge is that just cutting a little bit on that brand might actually be the same as not investing at all. For example, in countries where supporting a brand requires relatively frequent face-to-face visit to the HCPs, suddenly reducing that visit frequency to just visiting a HCP once a year, well, you might as well not do anything. And in that particular case, the area of cut below strategic option 1 really means that you're investing in an area where it is ineffective and maybe changing business model, such as, for example, licensing out a particular brand to a company that is used to dealing with mature brands might be a better option, or completely changing the channel mix that you would have could also be an interesting option. In fact, we propose to more formally integrate the long-term strategic attractiveness of a particular brand with the short-term responsiveness. Here in this matrix, which is different to the directional policy matrix we've seen before, we have the level of strategic long-term attractiveness on the vertical dimension and short-term sales responsiveness on the horizontal dimension. On the vertical dimension, we see brands here which are highly strategically attractive, the yellow bubble and green bubble. We see brands which are much less strategically attractive, which are the red bubbles and the blue bubbles. These are disease areas where there's little unmet need, where there's a lot of competition, price pressure, etc., etc. On the horizontal axis, on the left side, we see the green and red bubbles, where if you invest or you don't invest, there is relatively little responsiveness to these investments. What does that mean? That means that either the investment is taking a long time to come to the market because it requires, for example, massive changes in medical practice, or simply the market is so competitive, if you spend a bit more or spend a bit less, it's just not going to make a difference. On the right-hand side, we see the yellow and blue bubbles here, which are showing very strong sensitivity to investment, very strong sales responsiveness. That means that if you spend a little bit there, you would lose a lot of sales potential. If you spend a lot, you can gain a lot of sales potential. We then need to apply for each of these particular areas, which is the optimal approach to follow. So which scenarios to pursue for each of these particular 4 situations? Firstly, starting out with the yellow brand. This is a brand which is highly strategically attractive and highly responsive. So clearly in this one, the priority will be to boost the expense as much as possible, even jeopardizing profitability. Why? Because if it is strategically attractive for the long term, it really makes sense to boost the investment to maximize your sales. For the red one, clearly the scenario will be cut all. And ironically, these are great brands. They are mature brands. They're not highly strategically attractive, but they also don't have that much sales responsiveness. Most companies have brands in their portfolio which they don't invest in, and they either just stay flat or grow a little bit over time. And ironically, these brands offer extremely high return on investment. So these mature brands are really interesting to keep in the portfolio as they help invest in newer opportunities that cost a lot more. The blue area is a little bit more challenging. This is an area where there is sales responsiveness. So if you invest locally, you will get sales. If you don't invest, you can lose a lot. Those areas are not strategic anymore. As we mentioned, the long-term strategic attractiveness is not good because it's competitive, there's price pressure, etc. Here, the strategy should be to maintain if A, feasible from an access perspective, and B, feasible from an expense perspective. We should not, in these particular blue brands here, invest in 30% of the sales in various commercial expense. However, if just keeping it alive and keeping it rolling for a few years with just 2 or 3% of sales being invested in this brand, we should probably do that. And finally, the most challenging one is the green area. The green bubble here is actually a brand which is strategically attractive, which means there is unmet need. The brand is a great brand. It has interesting profile, it can get access, etc. But yet the brand does not seem to exhibit any sales responsiveness, which means that for next year you invest, but you don't get returns from that. And there the question is, why is that happening? Is that happening because it will be a longer term investment? Then we should probably bite the bullet and continue to invest. Or is this happening because there is something challenging in your market? I don't know. For example, all prescribers are outside of the hospital and you have an IV formulation, which is then going to be a little bit challenging, in which case this brand is probably strategically attractive on paper, but you'll never be able to get some sales responsiveness out of that particular formulation. So here you really need to study in depth, why is the brand not bringing anything in the long term, in the short term, whilst it is bringing something in the longer term. If you have the answer that in the long term the sales will develop, you should probably prioritize this. If not, this brand that might look strategically attractive for global functions will not have a future in your local country situation. So in summary, we're suggesting to develop strategic portfolio prioritization to understand the long-term priorities in your affiliate, and that is particularly useful in an environment where long-term financial forecasts are just not precise enough due to the Vuca environment. The second step is, rather than developing single option brand plans and then squeezing sales and expenses to fit the portfolio top-down financial targets, we suggest to plan for agility through developing multiple option plans based on increasing sets of key leverage points which are being addressed. And finally, we suggest to reconciliate those two approaches by making sure that for the strategic brands, you actually take the highest ambitious options, whereas for the less strategic brands, if the affiliate is in a tight budgeting situation, that you probably cut down on developing less key leverage points for a particular brand. If you have a further interest in this particular subject, please register your name below to receive further communication on this particular subject.